And we are rolling.
Okay, so we've got another different type of guest today. Dieter Schärer, or is that the correct pronunciation of your surname, Dieter, mate?
Absolutely, absolutely.
So another fabulous person that I've got to meet over here in Switzerland. Dieter is more from the finance sector, and maybe you could give a bit of a background as to what's your experience, Dieter, or what do you even call yourself? Are you an investor, financial planner? What are you?
Well, I would call myself a financial advisor or an investment advisor. My roots with regards to education go back to banking education, banking and finance. Then I also did the CEFA for an education for financial analyst and an asset manager. I have been working for UBS for many years, mostly in the investment banking side and a little bit of corporate finance. And then I moved on to private banking, where I've been looking after wealthy clients for the last 15 years now. I'm a financial advisor and investment advisor to a family office group and enjoy that very much.
Fantastic. So obviously we're in a bit of a special climate right now. I mean, not just financially, but also in terms of the health of the whole world. What we've got seen these crazy market changes, especially with the, sort of the election cycles and different stuff like this. And obviously with GameStop and Wall Street bets, which I'm sure, interested you quite a lot. What the hell's going on? And is this normal? Is this just another part of the cycle, or what's it like for you guys right now that are trying to plan for the long term?
Well, what has happened throughout 2020 and also recently, what you were referring to around GameStop and other crowd social media driven moves, obviously has added to volatility in financial markets. We have for a while, the financial markets and especially also the Western world has underestimated the impact of the virus when it all broke out in China and Asia. And I mean, I remember looking at CNN and other broadcasting channels, and I thought, well, why are these people buying toilet paper? But then, the wave came across, hit Italy first, and then obviously Europe, and the rest is history in the meantime. What did it do to financial markets? First, in March, they tanked. They went down quite a lot, quite a bit, and everything went down. And then right of a sudden, you realize there is a bit of a new normal developing. We are all impacted by that. We don't go out anymore. We don't go and consume services. We cannot go to restaurants, and we might be cut back with other services like not being able to go to the gym, for example, things like that. So the life environment has changed in the sense that everything is being done remotely, and so you could also observe that in the financial markets. Then all the technology stocks who are providing access to something like what we're using right now, a Zoom conference or other aspects of connectivity, they have risen and going up in price dramatically, whereas old economy, how we call it, old economy sectors of the economy did not perform, or actually are suffering badly. Things like cruise ships, planes, air traffic, anything that has to do with traveling or with entertainment is just just got grounded, so to say. So this was characterizing, pretty much of what has been happening throughout 2020. And then later on in 2020, we saw this very special development coming from social media impacted price moves in certain stocks. You were referring to GameStop. There were a number of other stocks which were driven up. It was kind of a crowdfunding thing where people got together and started to buy certain stocks. And in theory, they wanted to play against the big Wall Street firms against the hedge funds and all of that. And this added, again, massively to volatility in the markets. Now, how do you put all of that into the context of a long-term strategy? I think it has a lot to do with actually defining a strategy first, and then stick to it, and do not get excited and try to keep emotions out of investment decisions. I think that's a very handy advice, to put it very simple, and stick to your strategy. Obviously, you have to account for the changing circumstances. What did the virus do to the economy? But overall, I think financial markets in the meantime have learned to cope with what's happening and are reflecting to a certain extent the reality out there in the market. Some prices have gone up extraordinarily. I'd said too far, too much future expectations being priced in. But in general, I think markets are pretty solid and stable.
So the number one rule with people that have money is don't lose my money, right? Like that's your goal. Have you know who Ray Dalio is?
Yes, of course. It's the guy. He was been founding Bridgewater and is the most successful and the biggest hedge fund out there right now. Yeah.
So a lot of what we do with our professional athletes, essentially, we look at them as the super wealthy, and our job is don't get them hurt, right? So we want to make very, very modest gains every single year without any major setbacks, right? We're not looking to get them super fast to the point where they end up pulling a hamstring. We want to make sure that every single year, it gets a little better than the previous year. With a market like this, where I don't know anything about the market. I don't know anything about investing, really. I have a very, very small understanding of anything, but I can't understand, number one, why the market's doing well. If businesses are shutting down, unemployment is going up. We're borrowing money to pump into the market in order to artificially inflate it just for the time being. Essentially, we're betting on ourselves and hoping the younger generation can, I guess, cover this up. But I don't know why expectations are so high. The S&P is through the roof, and none of this makes any sense to me. I don't know how someone like you now can, let's say, do something modest in any kind of real calculation. How do you go about doing this?
Well, you're pointing at a number of very tricky situations, and you're absolutely right. It's a phenomena to see the S&P at an all-time high while the world is suffering many aspects of our life, right? Fact is, though, that the markets tend to look ahead of what is going to happen. And what the market is looking ahead to is that the vaccines are going to be a relief for the world, for humanity, and of course for the economy. And if you go back in history, look what has happened in the Roaring '20s. I mean, we had the most brutal recession, depression, and right after there was big party. I mean, there are jokes going around about, who is planning a party? Well, how do I get an invitation? Already now. And this is cynical in a way, but this is what's happening now. The markets do discount what's going to happen in the future. So actually, the vaccine is going to save the world towards the second or third quarter of this year, and there will be a massive amount of pent-up demand. And people are going to go out. And are you going to be sure? People are going to go out and want to travel. People are going to go back on cruise ships, maybe, and they want to spend a week or two on the beach, whether it's in Bali or in Australia or whatever. When things are opening up again, there's a massive pent-up demand and a lot of money to be spent. Now, who has the money and how do they get it? That's a different question. I mean, the big programs which are being initiated by the governments and by the central banks obviously pump a lot of money in the system, which in a way you can say it has never been worked for. It's just artificial. And this is the tricky thing about it. And you're absolutely right. I think this is going to take decades to pay off at the end of the day. And I think it's going to be not only our generation, it'll be the next generation who's going to pay for what kind of liquidity, what kind of money is being pumped into the system these days.
So how do you go about knowing all this information? How do you go about investing conservatively? I don't know, like the bonds market now is because the Fed cut the rates, right? Bonds markets, you're not getting anything. And I know Ray Dalio does what, 40% bonds, 30 or 40% bonds of what, 3.5% yields, right? So what are you doing to safely secure money? I don't understand it.
I think it's not a miracle. It goes back to what I was alluding to before. You need to have a strategy. Now, Ray Dalio does bonds, yes, and the interest rates actually 10-year Treasury bonds, they yield 1.3%. So it's not 3.5, but it doesn't matter. The fact is he is arbitraging. See, he's arbitraging along the yield curve. He's arbitraging different ratings in the space. And he has a lot of other macro decisions he's taking in order to have a well-diversified approach. And actually, this would be my advice as well. Whenever you start investing, do not put all your eggs in one basket. You want to diversify. Fixed income bonds, as you said right now, they yield next to nothing. In Switzerland, they yield negative. So it's a major challenge. And equities, you can argue whether they're too highly valued or not. But it all comes down to a strategy to set your goals, what you want to achieve, stick to the strategy, and then it is all about diversification. You do a little bit of bonds because there's always some, you picking up dimes in front of a tractor, right? But you're picking up some returns, small returns, in order to stabilize your portfolio. And on the other side, you might be participating with some of your money with the stock market. And you then combine these elements, use different asset classes in your portfolio and try to balance risk out. You might even have real estate, whether it's your own home or whether you will be buying real estate stocks. You're just trying to diversify your risks in order to steadily grow your wealth. And you're absolutely right with what you said before. First thing you do not want to happen is to lose money, because each time you lose, you have to make it back up. And the mathematics are brutal. If you lose 50%, you need to make 100 to get back to square one. And that's what you do not want. You want to have a steady line. You will have volatility, but you want to have a steady line of portfolio development over years.
So have you ever read or heard of the book Rich Dad, Poor Dad?
No, not familiar with that. No.
Okay. Brooker, have you? So
yeah.
So with Rich Dad, Poor Dad, it's like artistic, and it's very easy the way he explains things and the way he seems to do things. But I mean, he'll talk about real estate and then trading up, right? He'll buy things cheap and then hopefully it appreciates. Then he'll trade that in off of really low investments. Like I think one story he told was off a $5,000 investment, he was able to turn it into $1 million over a series of years. With financial planning, it's super, super conservative. How do you guys go about balancing that? Are you involved in those aspects of wealth management, or are you strictly with stocks? How do you go about doing all this?
I'm not very familiar with the example you were using there, but the real estate bubble, which actually led to the 2008, 2009 financial market crisis, was as a prime example of what leverage does to a system. And if you make that much money, if you grow $5,000 into $1 million, I must assume he's been taken some very brave decisions, brave steps, and he must have used leverage. Otherwise, this is not possible. And maybe this is another advice I would like to give anybody who's listening to this and watching this podcast here. Be careful with what people are telling you what is possible, because usually any kind of return, any kind of performance does come with a risk. So this guy might have been very successful. He might have been able to ride a wave, a real estate wave, and he might have been able to use a lot of leverage in order to grow $5,000 into $1 million. But that came as a risk, because at some point in time when things turn around, he might as well lose a lot of money, right? And I'm not in the business of this kind of bets. That more sounds like casino, right? You're betting either on red or black, and either you'll double your money or you're out of business. My job is to exactly prevent that, of getting out of business, to balance risk. And balancing risk means that you have lower returns but stable returns, and it depends a bit. And this is important for whoever decides on what he wants to do with investments. It's important to assess your own situation. In what stage of your life are you? Do you have commitments? Do you have children you have to take care of, or are you on your own? Can you take bets? Maybe you can, and then when you lose money, it's your own money. That's it, But if you have a responsibility towards others, or if you have liabilities, like you have to pay down a mortgage over time, you want to be careful how you structure your investment approach, and hopefully, and not hopefully, but you should be able to meet your obligations over the years. And I think that's a solid advice when you start investing. What the other guy did, he took a shot and he was successful, and then he rolled it over, and it was just riding the wave. But there are some movies out there. I don't remember there's one particular movie that showed how the financial market bubble was created in 2008, 2009. One of the hedge fund managers who actually detected all of that subprime paper went to Florida, if I recall it correctly, and then went to a strip bar and found out that the strippers there, they all held on to 3 apartments, and they all wanted to trade apartments up and up and up. And it was like a perpetuum mobile, and it was just going in one way until it broke.
Yeah. That's it was called The Big Short, I think the name of the
Big
movie.
Short. You're right. Absolutely. Yeah. It's a great movie to watch. Needs a bit of financial understanding, but you get the basic message of what was happening at the time, and how this bubble was growing over the years.
So, have you heard of a guy? Now, I'm gonna do really, really popular stuff, because in our industry, all we get a hold of is real popular things. So this is what we gravitate towards, and this is what our information is based off of, is what these guys write. So Rich Dad, Poor Dad is a real popular book. They say, oh, read this. And then everyone's like, oh, okay, let me give this a shot. Let me give that a shot. There's another guy named Grant Cardone, and he is very, very popular. And Grant Cardone has this model he calls 10X. And everything this guy does is based off leverage. So he'll start a construction project, and it'll be borrowed money, and you'll put down, I don't know, to build it from the ground up, something like 20% or whatever it is. But then once that project gets going, the value of it increases, and he takes a loan out on that project and starts another project, and does the same with that project and that project and that project. And the guy has hundreds of millions of dollars worth of projects all underway, all under leverage. So a lot of the richest people, or the recently successful people, everything's built on leverage. and they say never, what is it? OPM, other people's money, right? So it's all live on leverage and make all your money off of someone else's risk. How is I don't know where to even begin with anything like this. Can you explain any of this?
Well, this is a very risky strategy. Leverage always is risky because you own money to somebody else. You said using other people's money, but usually the leverage comes from a bank. And if you're not able to serve the debt, i.e. to pay the interest rate and then pay back the loan, the leverage you're taking up, then they're going to squeeze you, right? And you're going to be going out of business. So all of that only works if the markets go one way. And sorry, this is something I'm not in the business. I don't have a crystal ball. I don't know where the markets are going. This guy certainly takes a huge bet on a cycle, on a development to last, and keeps on rolling and keeps on taking up that debt. Debt financing is interesting in a sense that you leverage your own equity, your own investment by that extra amount you're taking up. So the return on your own investment looks fantastically great, but at the same time, you're adding risk. Each time you add on leverage to a strategy, doesn't matter which one, whether it's development, real estate, whatever, each time you're adding risk because you will be losing economically. You will be losing more than what you have put in. And so you might be going out of business. So you might end up bankrupt. So there's the only thing I can say to this, great if he's able to ride that wave, fantastic, but he's taking a lot of risk. My advice to anybody would be not to do that. If you are very brave entrepreneur and you want to take that risk, you're fully aware of the risk, go ahead. My advice, if you want to sleep well, maybe use a slightly more conservative approach. My approach is more like diversification, steady growth. Like Einstein once said, the compounding effect is the eighth wonder of the world because it's so strong. Making 3% every year or 4% every year over 20 years is tremendously strong. Losing 50% is a pretty decent and pretty tough setback. And that is, 50%, or when you're leveraged 100%. If you don't mind, you can go after strategies like that. I'm not in that kind of business. I'm more diversification, lower returns, but steady growth, and use the compounding effect over the years.
Will cryptocurrency become part of the diversification that you're going to get involved with?
Definitely, yes. We already were involved in cryptocurrencies. We have done an analysis around the Bitcoin. I'm using Bitcoin as a reference. I'm aware there are many other cryptocurrencies out there, but we have done analysis on Bitcoin around the level of $12,000, $15,000. We came to the conclusion that cryptocurrencies and Bitcoin in particular offer a degree of diversification. Again, it becomes a tool to store your value, and it could become a tool for payments. And as a combination of all of that, it could become an asset class. Now, a lot of that has happened in the meantime. It has become a store of value. You were referring to the fact that a lot of liquidity, a lot of money is being printed, a lot of liquidity is being thrown at the system. So the value of money is questioned, whereas Bitcoin has a cap. I don't know whether you're aware, but the maximum amount of Bitcoin ever in circulation will be 21 million, not more than that, right? There's a cap on that. That has been done it has been prepared in the model and the algorithm of that Japanese guy. And so 21 million is the max. It has become, or is about to become, a payment tool. But the transactions in Bitcoin are very complicated. Opening up a Bitcoin account is complicated as well, and it can be costly. So I don't think it has really established as a payment tool, and it has become a bit of a store of value for the digital generation. You know, old-fashioned guys like me, we might be owning a bit of gold as part of the asset allocation. Younger generations might be owning Bitcoin as a store of value instead of gold. I today would say you want to most probably own a little bit of both, right? Now, Bitcoin, on the other hand, you need some pretty tough nerves in order to follow the development. It goes from 15 to 55 today. Almost as we speak, it dropped from 55 to 48, and right now it's at 53. So huge swings, and not every investor is capable of dealing with such a volatility in his portfolio and his wealth. So be careful how much you allocate to Bitcoin or any cryptocurrency, and how much you are able to cope with the swings of that. But to answer your question, Alex, clearly Bitcoin has or is about to establish itself as part of an asset allocation. It doesn't help if Elon Musk is telling everybody that that Tesla bought $1.5 billion in Bitcoin, and the price shoots up from 30,000 to 50,000. It just adds to the volatility. But in general, there is an increasing acceptance for cryptocurrencies, for the use of it, and it might become part of an asset allocation. I think there's a bit of a time lag there. It'll be taking some time until it's established as an asset class or as a part of an asset class, but it's getting there. What has happened in the last, 4 months? Don't know whether it did well to the idea behind it because of the volatility has created, but the trend is there.
What are the consequences? So say, like, for example, when there's hype, like Elon Musk tweeting or something like that, and Bitcoin shoots up, and people jump and ride this kind of bull market, right? And then they're trading in between, and they're making quite a lot of money pretty quick. They're getting quite excited. I mean, outside of maybe not being so educated and looking at it in terms of a long-term strategy, what are the negative consequences to it? Is it just the fact that the people have a lot of money in something that you can't really use right now, or what's actually the negative consequences to it?
Difficult to say. The question is also who actually makes money and who has been able to cash in on the recent moves and recent development. And the question always is, what would these people do with the money? I don't know who did participate in the whole hype, but clearly the social media hype and the social media participation has led to the fact that a lot of people are somehow trying to capture the trend. The negative element of all of that clearly is the volatility, which I was describing before, because obviously it's very difficult to assess a price to pick Bitcoin, because when you look at the standard valuation tools and looking at a company, you're trying to see how is the company positioned, what are they producing, are they successful in selling their products, what are the future cash flows, and how much dividend are they going to pay, and you keep on, you do all of that. With Bitcoin, there is no cash flow. It's not generating anything, right? It's a pure supply demand game. And whereas when Elon Musk gets on Twitter, he is moving the price of something like that. I, as a conservative investor, don't feel particularly comfortable with such price moves on the back of a Twitter message, right? That has nothing to do with what it is all about. I do hope Bitcoin might establish itself as an asset class might establish itself as a store of value, and hopefully they will be used to it by using Bitcoin as a tool for payments. All of that is not happening right now. All of that right now is a future expectation, and the present is a momentum driven by Twitter messages and the hype on social media, right?
To be fair, though, one Twitter message from the right person can impact any stock, though, right? So how do you prevent anything like that from? I mean, a tweet. If Elon Musk were to say, "Hey, just so you guys know, I'm putting $1.5 billion into Ford," right? Ford stock would go through the roof as well. So, I mean, it doesn't matter whether it's crypto or not. The only thing that I don't like about, well, there's a lot of things that I don't like about crypto is who is saying the value of it? Like, what does it do? I don't understand where the value actually comes from, other than it's supply and demand, but for what? And what happens when one country says no more Bitcoin? We're banning Bitcoin.
It's a very, very important point you're making here, because obviously the regulator, governments and financial market regulators are closely watching what is happening around cryptocurrencies and Bitcoin in particular. And there again, just to go back to Alex's question, what is negative about around it is the volatility. You do not want to have something which is you cannot rely on. If you want to go and buy a car, okay, maybe Elon Musk is going to accept Bitcoins at one day for his Tesla cars, but the move of your currency goes up and down like mad. You never know whether you'll be able to afford the car or not afford the car, right? So that reliability is still very much missing. And hence, you're quite right, the regulator is looking very carefully at how this is establishing and whether they need to interfere. And they would say, no more Bitcoin trading. And then, of course, you would be faced with less demand for Bitcoin, and the price were to drop quite clearly. And that's the issue. This is a process, and we're in a process of acceptance. It's not accepted yet, but in a process of acceptance. But going back, when was that? About a year ago, when Facebook wanted to create their own currency, right? And the regulator stepped right in and said, no way, you're not going to do this, right? Now, Bitcoin is independent from governments so far, and is rarely regulated. This might change going forward. But what it really is, it's still scarce. So the supply demand thing, but the fact it's only 21 million max of outstanding Bitcoin, the supply demand string, that plays very strongly in Bitcoin. And then obviously social media has an impact, because you see this demand side popping up in waves, and at the same time, and then prices go up like mad. Now, what you were referring to also is like, this could happen to any other stock. Yes, it could happen based on Twitter, but I don't know how familiar you are with the guy called Warren Buffett. Warren Buffett runs one of the biggest investment vehicles in the world, Berkshire Hathaway, and on a regular basis, he publishes his stock holdings are and what kind of changes he undertook. And yes, whenever he does that, it has an impact on what he has bought and what he has sold. Other people are following Warren because he has the reputation of being an investment genius, right? But this is not lasting. This is the company itself at the end of the day has to deliver, and will have to deliver in the months and quarters and years to come. Mm-hmm. But in Bitcoin, you have that concentrated attention and then concentrated buying, which drives up prices and increases the volatility. And there, the impact is much bigger when somebody like Elon Musk is twittering, as compared to Warren Buffett issuing his quarterly report of his purchases and sales.
So our listeners are mostly, actually, I shouldn't even say mostly strength coaches. We have a lot of other people that listen to, but for the people that really don't have any kind of money and they want to they want to use a guy like you, but you have a minimum, right? There's a minimum investment that some, or a minimum net worth that someone like you will take on. And same thing with my pro guys, my professional athletes. They're, some of their guys like, well, I don't talk to anyone unless they have $10 million. So what do you tell these people to do? Do you just say, hey, throw money in the S&P 500? What, because that's what all these books are telling people to do. It's, hey, Warren Buffett says, just go in the S&P 500. You'll be fine. Don't worry about it, and play the long game. 10 years down the road, 30 years down the road, it's going to be a win. How do you direct someone, or how would you direct someone with very, very modest means?
I'm going back to remarks I made earlier. It's clear, it's definitely something you need to decide for yourself in what stage of your life you are and how much money you are able to invest. So if you have obligations, if you have liabilities, be careful to take this into consideration. And basically what you need to do for yourself is you almost need to fill in an investor profile. So first of all, what is my time horizon? While you're a student, most probably you're not able to afford investments, right? Because you're just struggling to get through the current life. So you're certainly not going to put money in a Bitcoin where you can be very rich one day and you can be very poor next day. So basically you need to answer a questionnaire for yourself. Time horizon, what do you want to achieve, and how risk tolerant or risk averse are you, right? If you lose sleep because of volatility of your portfolio, which is going up and down, then maybe you just don't want to start investing. So you need to have a certain reluctant and also be confident about your strategy. Don't fool yourself when you set your parameters. I want to grow that wealth over the next 10 years. I don't need it right now. And I have the time to wait and see that money or that wealth grow or that portfolio grow over time. Worst thing is if you need to sell in a fire sale, right? So if circumstances occur that you need to sell your portfolio down, you bet it's Murphy's Law. It's at the worst possible moment in time. So you don't want to end up in a situation like that. But if you have answered all your questions, and at the end of the day, you stand there and you are able to invest 50 grand or 100 grand, there are a lot of people, a lot of banks who might not be willing to advise you with these small portfolios. But it's not that bad of an advice to at least put part of that into the equity market. And there are cheap ways to do so. You don't need to go and select Coca-Cola, Pfizer, and in Switzerland an ABB and a UBS stock. You can go and buy so-called ETFs, exchange traded funds, which replicate certain markets. Very cheap management fees, and you buy and sell them in Switzerland, I guess, over Swiss code, and other countries also, very cheap transaction fees. And then you just leave it, because dealing in and out, usually it's each time you take a decision, it can be a bad one, right? But if you have a long-term strategy, stick to it, stick to your portfolio. Hopefully you have somebody to help you construct it in a sensible way, and then leave it. The advantage of having a strategy is clearly that you don't get nervous when things turn sour, because you have that guideline which you want to follow over the long term. And it also, with a strategy, hopefully prevents you of making emotional decisions, right? Because emotion most of the time lead to bad results, right? Many of your athletes, I guess, especially the ones who are in a competitive team sport, they know how bad emotions, you need emotions to deliver strong performance on the pitch, right? Or on the ice rink. But you also need to control your emotions with your opponent, and do not get excited and don't take it personal. So here, investing also is about controlling emotions and stick to your strategy, because you have a mid to long-term goal you're trying to achieve, and you don't sometimes reassess your strategy, but don't let the emotions drive your investment decisions.
And one of the things you were mentioning always about strategy, I mean, we can relate completely, because the higher level the athlete, the more you're sort of much more conservative, and you don't really need to try to go bust on them, right? Now, one thing I heard years back was everybody thinks the hardest thing in the world is to earn money, and then the contra is actually it's when you've got money not to lose it. Now, in terms of this, I mean, you'd mentioned about always very low yield and diversification. Is that kind of like for the people listening, is that kind of a guaranteed way that it's going to slowly go up? Or is that also dependent on this very volatile market that you might see that even if you do spread it really well, is there always sort of these cycles where it's going to change anyway? You know what I mean?
I think I know what you mean. I mean, certainly the current environment is a difficult one because of the very low yields. And you can compare that, and I don't know how many of your athletes are actually in a pension fund, but when you see what the pension funds are able to achieve, these are professional investors, right? They invest the pension money of thousands and thousands of people, right? And you see what they are able to achieve, and you see how they're struggling to achieve, I don't know, 2 or 3 or 4% per annum, right? And this is the challenge you face it with right now. In Switzerland, you have negative interest rates, or you have low yields across the globe. So it is difficult to generate a decent income. Hence, if you were to allocate more to equities, you have a higher risk profile. Again, that not everybody is suited to do that. So you want to structure also maybe your investment in tranches, because we live in a world of cycles, and cycles go up and down. And so what we have been able to observe, for example, is that yields are slightly rising. So fixed income or bonds become more attractive. You don't need to deploy all your money and your investments on day one. You might want to, for example, put some money into the market, or start investing on a quarterly basis, or and do another tranche at a quarter later, and then spread your investment money over, I don't know, 12 months, 18 months, or 24 months, in order to flatten and not take the risk to step in at one moment in time and then being exposed from one day to the other. But clearly, and I hope I'm answering your question, the prospects of high returns right now are quite limited. You gotta be happy in Swiss franc terms if you are achieving 2 or 3%. If you keep the money on the bank, they're going to charge you 75 basis points, so almost a percentage point, right? So in your portfolio generates 3% per annum, you're up 4. That's great. And if you are up 10 years in a row, you're up 50%. So that would be the aim to achieve over the long run.
What books would you recommend, or what information would you recommend for people to start absorbing in order to really get a competent understanding, or a base level understanding of any of these things? So, like, what books do you read?
Well, one book which really is an old classic. It's by Peter Lynch. It's One Up on Wall Street, right? and it explains in a entertaining way on how he has been selecting stocks. This is unfortunately not about a portfolio construction, because Peter Lynch was a equity, that was a stock market investor, but he was using examples of things where he has chosen to invest in, which are close to his heart, right? And which he was able to understand. So yes, Bitcoin is in everybody's mouth and in everybody's mind. People who do not understand Bitcoin, and I guess there are a lot of out there, and not to blame them, because it's very complicated to understand the algorithm behind it and the model and all of that. Maybe you don't want to start investing with Bitcoin, right? But you start investing with things you understand and which are close to your heart, as I said before, and that helps you to get into the theme. I mean, I remember one anecdotal evidence from Peter Lynch's book where he was saying, you guys are far too young to know that, but there were 30 years ago, there was a company producing stockings, and the stockings were put in eggs. And the eggs were at the Walmart cashier, like where all the sweets are usually, right? Because every housewife or every mother who is queuing there to pay her groceries with their babies and children next to her, she will be under pressure to buy some of the sweets. So the spot next to the cashier is the most interesting spot to play things which are actually not necessary to be bought, but they will be bought, right? And so they sold these stockings in the eggs next to the cashier, and Peter Lynch's wife kept on buying these stockings, right? And he thought, well, what is it all about it? And then he started his research on the company and found out what they're doing, and they're kind of reinventing their selling practice or selling attitude, and were very successful. And if you use things like that, I think that helps you to build a known portfolio. Obviously, this goes against my previous advice to buy ETFs, because ETFs, you're not engaged emotionally or whatever, or which is close to your heart, you're not engaged at all, because this is a passive investment. You're just buying the market. But in some ways, talking about reading books, it helps you to understand things which are combining finance and where you're coming from. That should help you. I wouldn't be able to quote a book which has a reference to sports and how people are investing. There are plenty of examples of very famous sportsmen, and I think, Alex, we spoke about that before. Famous sportsmen who lose a fortune while listening to bad advice, while doing bad investments, and just being cheated left, right, and center. There's a prominent example in the entertainment industry. Johnny Depp, I think he made something like 600 million in his life, and he's bankrupt. Things like that. So, but listening to bad advice and following the wrong people, I think that is the biggest danger you face out there.
It's funny because the guy that we spoke to, who you sent me the news article about, Mike actually knows him. So he won't say the guy's name on the podcast, but we'll talk about it afterwards. In terms of then about, for the general layperson, what is some sound, basic, and I mean, we'll go really, really basic financial advice? Because another popular book that's out there is The Richest Man in Babylon, which talks about, for if you get paid 10 pennies, make sure that there's 1 penny that goes away, that you pay yourself first so that you never spend it. And then maybe you spend another penny on some kind of long-term investment, and then another one can go towards charity or something. So that at any point you're only spending 70% of any sort of income that you've got. What are the key fundamental basics, in your opinion, for basically anybody? It doesn't matter how much they've got.
I look at investing in 3 ways. One is return, one is risk, And the third one, which is key to me, and this is why I'm a very hesitant user of leverage, the third one is liquidity. I always want to be able to react. And this also goes a little bit to my advice I gave earlier, maybe not to just put everything at work at once, but scale in tranches over time. So since we all don't have a crystal ball and we don't know what's going to happen, I will always keep some dry powder, right? So you invest in tranches, but always keep something in some money, cash, liquid, dry powder in order to react to adverse circumstances if markets were to, become weaker and you want to add to your positions, or when there is an exceptional opportunity that you have the flexibility to react to something like that. So I would never go to 100% invested, but that's me. But that would be my advice. The three elements is return, risk, that needs to be in balance for everybody. So you do not want to lose your sleep while investing, right? And the third element is keep your flexibility. You never want to be the victim or the slave of a bank, because banks are gonna force you out of positions. The guy who was so successful growing $5,000 into $1 million, he was at the mercy of the banks when using that amount of leverage. That works well in good times, but you also want to be a captain in stormy seas, right? And that's when you want to be the master of your own destiny. And if you use too much leverage, if you use leverage in general, but if you use too much leverage, then you're exposed to the banks and you're not the master of your own destiny. Somebody else is going to decide for you when to get out of a position. So these are my elements: risk, return, and liquidity, which keeps your flexibility.
So if you ever see my training, you'll know exactly how I invest, because I am a total coward. If you watch my guys, we do very, very simple things. There's nothing sexy about our training. We make small gains. That's why Ray Dalio is so. I loved his book Principles. It just made the all-weather portfolio that makes so much sense to me. It's perfect. It coincides with my training. Now, my father grew up very poor, and his father ended up not doing well, and his mother got sick, but he was fortunate that his dad was able to pay off his house in full when he was younger. So they didn't lose the house. They always had a place to live. Now, when I'm looking to buy a place to live, the first thing that comes to my head is what was instilled in me: buy your house outright. So if you could afford, pay off your mortgage. Now, with the way mortgage rates are right now, you could get a mortgage for like 2.3%. Everyone is telling me, get the mortgage. You'll make more money on your money if rather than buying the house straight up. But I am so conservative. I'm just like, let me just buy this house outright. I want as little as possible. And every single person is telling me how crazy I am. But my father and me and my dad isn't a dumb guy. He's a former CFO. So his whole thing is risk mitigation. So you got this, and his mindset is, well, you're going to continue to make money. This chunk of change right here, yeah, it'll make money for you, but at least you don't ever have to worry. So what is your outlook on something like that? What's your take on
that? When you take up a mortgage, again, you're borrowing money from a bank, but the question is, how will you be able to serve the mortgage? So one of the serving of the mortgage is paying the interest, and the interest is very low right now. So what you want to do if you are using a mortgage is most probably you want to secure the interest rate for as long as possible. You can take up a 10-year mortgage in Switzerland, for example, or I guess in other countries as well, and maybe even longer maturity. This gives you, first of all, the interest rate is very low, and it gives you time to build your substance in the meantime to maybe pay back the mortgage. Now, if you had the money and you would not need the mortgage, it's a completely different ballgame. I think your question was referring more to you would have the money, but you're still taking up a mortgage. And this is taking up leverage. Obviously, it's very cheap leverage and it's secured by your house. But there I would say you can still use a little bit of that. It's a bit of a contradiction now, but I would still say there is a possibility to take up a bit of a mortgage, even if you were to afford the house completely. But maybe don't take up more than 50%, because that is never going to kill you, right? Because you got the house against it. And the bank is never going to get you out of the house because of a 50% loan to value mortgage. So you're safe on that. So I think that's a bit of a compromise I would suggest to do. Yes.
Oh, that's interesting. I didn't know that information. So we have 30-year mortgages in the States. So if we locked in a 30-year mortgage at 2.3%, whatever it is, pay. So you would say with someone with a low risk tolerance, go 50% down on the house, and then you're okay. They won't likely take the house from you for 50%.
That's what I'm saying. I mean, I think the regular loan to value they would offer you is something around 70%. So you've got a 20% cushion in there. I'm not that familiar with the house price developments in the US, and obviously they can vary by 20%. But clearly you got that cushion in between, and this is why I think 50% loan to value, you should be okay. And even if there is a downturn in house prices, they're not going to ask for more down payment immediately. I think you should be pretty safe on that. The other thing is you need to generate more than 2.3% return, right?
Yes.
So that's a challenge. Otherwise, it's not adding up, right? But 2.3% do not sound like a lot. So as long as you're sticking to a solid, diversified strategy, you should be able to generate that kind of return. And if I may, I would just quickly go back to your remark about the all-weather portfolio of Ray Dalio. Just by way of information, this year, or rather 2020 was a bad year. So the all-weather hit the perfect storm. I think the portfolio was down 9%.
Wow.
Right? But you were right. I mean, over the last 10 or 15 years, it's been a tremendous portfolio. But clearly, last year it hit the perfect storm, and I think they finished the year down.
So what's funny is I have some really high level professional athletes, and they got me talking to some very, very high level investors. And one thing that they told me was that right now, actually, this was summertime, Ray Dalio was on a gold buying frenzy. Like he was just trying to buy as much gold as he possibly could. And he was obsessed with it. They said just gold, buy. That's all he was about. I don't understand why. I mean, maybe that's good information. Maybe that's not. I have no idea. But I don't understand why someone would go and do something like
that. To be honest, I haven't heard that he's been buying gold. I mean, I know he has been buying gold, but not as much as the way you were describing it, that he would be buying gold as much as he can. And also the price development of the gold itself doesn't really show that. Now, gold is a very, very special metal, because gold is like, is a reflection of financial market stability. And there is always this conspiracy theory that the gold price is manipulated. Hence, the governments and the banking industry does not want the gold price to rise too quickly, too high, because it would signal the market, the financial markets and the investors that something wrong in the financial market system. And this is why gold has a tough time to really go massively up in price. Now, I am far from a gold bug, how these people are called who believe in that conspiracy theory. But I think clearly that in a world where money, fiat money, which is being printed like there is no tomorrow, and the debt burden are just going up across the globe, that gold certainly offers a very strong case for a store of value. And there is this old saying, an ounce of gold buys a good man's suit. And it goes back to the Roman Empire, where an ounce of gold would buy the equipment for a Roman soldier. And still today, if you look for $1,800, it buys you a nice suit. And that means that your purchasing power over 2,000 years and more has been kept stable. And there is not many other payments of tool or monies which can say the same about themselves, right? It doesn't work that way.
I never heard that. I really like that.
I think it's a good example of maintaining purchasing power. You know,
yeah,
the $1,800 they buy you a suit today, and the 1 ounce of gold bought the Roman soldier the equipment, and he was well to go. And if you look at what has happened to some of the currencies, I mean, when I grew up, the British pound was at, I think, 5.5 francs. So I needed to pay 5 francs 50 for 1 British pound. Today, I buy it for 1.30.
Yeah.
Dollar used to be at 2.5. I needed to buy dollars at $2 francs 50 for $1. Now I buy a dollar for 90 rappen, 90 cents. So this is the devaluation of money, and there I think gold has a means in a portfolio composition that it's part of wealth preservation. It also fluctuates in price, but it keeps its value over a very long period of time.
When I was living in Colombia, obviously it's next door to Venezuela, so I saw and heard a lot of the horror stories that was coming out of there with a collapsed economy. And you hear all the time about there's going to be a crash coming and the debt is just going through the roof. With a collapsed economy, is that something that happens gradually, or is that just like overnight money all of a sudden means nothing? Like, it might sound like a stupid question, but I have no idea.
I mean, what I've been referring to, like the price of the dollar or the pound over many years, that was obviously a gradual move, and was
right.
A reflection of the stability of the Swiss franc and the solid political system and the solid economy. And that is something which is supporting a currency or devaluing a currency, depending on what kind of economy and political system you have, over many decades. Now, what you were referring to was just I think was a combination of many incidents. A lot of these countries, and that's not only referred to Venezuela, they run current account deficits. So they basically depend on foreign money influx, right? Because they're not self-sustainable. That already puts pressure on the currency itself. The many other aspects, not producing anything, you're not exporting anything. There are countries which one would think they're in a perfect position to be self-sustained with regards to agricultural production, and yet they're not. So things like that, they all come together. And in the case of Venezuela, it was certainly the mismanagement of government together with the collapse in the oil price. I mean, when you make a lot of mistakes, it doesn't matter that much while the oil is just coming out of the sea and out of your oil wells and is paying for all your bills. But if the price for oil goes down dramatically, your mismanagement in the government pops up, and then it becomes obvious, and things just don't work together anymore. And there are many cases in the world. Argentina, I think, don't, I think they have defaulted something like 13 times in the last 50 years.
It's the worst performing currency still, I think. I mean, when I was there, it was horrific. People were investing in secondhand cars there because they couldn't put their money anywhere because they didn't know what it would be worth the next day.
Oh,
They didn't want
Correct.
to keep it in banks. Yeah.
So it is, you need to look at what how government finances are, and how for example, many countries, it is important how the government can enforce tax collection. I mean, if you look at what has happened in Greece, European country, Western country, and yet almost nobody paid taxes. How can a government, how can a country function if you don't have income, right? So I think that was one of the issues around the Greek situation. But there are plenty of other examples where things just don't add together, and then add up, and then you're obviously having a permanent pressure on the currency, because nobody wants to own the currency of a country which is unreliable and might not be able to honor its debt.
I know we've kept you long, Dieter, but I got one question, last question for you, and I'm sure Mike's got one for you too. So have you got time, mate?
Yeah.
Okay. When's China taking over the world, man? Because, I had some friends that were in Baghdad not too long ago, and they were mentioning that all they could see on the streets were, Chinese, and you can see that the Chinese are building up Africa and rebuilding the Middle East. What's your prediction with China? Is the global currency going to still be the dollar in 10 years, 20 years from now?
Well, to answer your first question, I think China is actually conquering the world as we speak. And you used a number of examples. I think there are millions of Chinese working in Africa on airports and infrastructure build out and things like that. I think there are Caribbean islands which are, roads and airports and stadiums are built by the Chinese. And it's part of their trading diplomacy, if I may say so. They invest a lot of money, and then they make these countries dependent on them. They give also loans. Again, you're not the master of your own destiny anymore if you owe money to the Chinese. The Chinese are going to tell you how you're going to do your politics, and they will also obviously try to influence foreign policy. So I think the Chinese are actually slowly but surely trying to conquer the world, and it's going to be a big polarized world, something which we are seeing right now already. I mean, in the past, I grew up during the Cold War. There was the East and the West, a bipolar world. Today, we have these big economic blocks, whether it's China, whether it's the US, whether it's the EU. You've got these blocks competing against each other. But clearly, right now, the strongest hand, the Chinese have that in hand. They have the strongest cards in hand, and they're playing it smartly. They call it the new Silk Road. They're building out of Asia into Europe. They're buying infrastructure assets across the world. To use two examples in Europe, they bought most of the port of Piraeus in Athens, in Greece. They have invested a huge amount into the train stations of Düsseldorf, and all the trains go all the way from China into Western Europe, into Düsseldorf. Nobody looked at these train station anymore. It was not interesting. The Chinese bought it very cheaply, and they're building it out as a merchandising hub across Europe. And there are plenty of other examples, and they do that very smartly. What I'm very much concerned, as long as they do that on a trade basis, and when they're trying to sell their goods and spend their money on infrastructure investments, they could also change attitude and become more aggressive. And I think one country which is going to feel the Chinese aggression first will be Taiwan. I think this is the biggest risk for the world, is Chinese-Taiwanese tensions, and when they want to get that island back into their, into their country, because Taiwan is really something they are eager to get back. And if you use a 10-year time horizon, I'd say Taiwan will not be the same as it is today.
Dieter, fantastic, mate. Mike, you got something else?
Yeah, knowing that information or predicting that information, where are we putting our money on that?
Yeah, how can we invest into China?
Well, there's a maybe just being a bit granular, but I don't know, the chip industry, microchip industry. I don't know if you guys have been following what's been happening. There are basically two chip generations, one being developed by Intel and then the other one by TSMC, right? And the fact is that TSMC chips nowadays are much better than Intel chips. And so the Chinese want Taiwan back because they consider that their mother country, right? But it's also about a technological war. Now, I don't know whether you want to go out and buy TSMC stock, because they're really gone up in price already, but it's all about technology and technological advantage. And right now, there's a lot of technology available in Taiwan, which they're very keen to get their hands on. So, if you buy Taiwanese stocks, if you go buy TSMC, you might be exposed to some very negative news if the warships start cruising in front of Taiwan, and the markets might go down. But basically, it's the technology which is absolutely leading. And, it's also one of the things they want. They want that technological advantage. Yeah. But it's difficult to make money on wars. But there was, just quote another famous investor, not so famous in the Anglo-Saxon world, but in the German-speaking world, Costolani. He said, you need to buy when the cannons are firing. Yeah. And you sell if there is too much greed among investors. But in war times, if you're brave enough and if you have that liquidity set aside, the dry powder I was referring to before, then there are some great opportunities to invest. Not to make quick money, but to start investing into solid companies at a cheap price.
Fantastic. Dieter, thank you so much for your time, mate.
And stay on the line real quick.
I will.